Welcome to the continuation of Principles of Accounts. We're going to take a look at recording of business transactions. This subtopic is going to be delivered into two videos. This is video number 1. A record of business transactions is called an account. This subject is Principles of Accounts, which basically means we're studying how to record business transactions. A collection of accounts is called a ledger. Different types of accounts are all recorded in what is called a ledger. Before we can go into how to record a given type of transaction, let's take a look at the different types of accounts. So all accounts that form up the ledger can be grouped into 3 classes. These are personal, nominal, and real accounts. Let's start with personal accounts. So what are personal accounts? These are accounts of individual persons and organizations with whom the business deals with. You have a business, for it to operate, it buys and sells from or to other businesses or to people. Okay, so the accounts of these people or the accounts that relate to the transactions that have to do with these people or these other companies are recorded in what are called or are classified as personal accounts. So normally the way the way accounts are treated, we usually record transactions that are on date so that we're able to keep track of what happened. Okay, so by on date I mean where there is no cash involved. It can happen that you sell something, so that person agrees to pay you later, so that person is your debtor. So such an account, we're going to record it as a debtor. And the opposite also is true. When you buy something, you will have a creditor. You become a debtor to another business, but that other business will be your creditor. Okay, so such types of accounts are what we record under personal accounts. So in short, they are debtors and creditors. Examples might include Oscar Limited, Brighton Investment, Bilgam Tuitions, Tradekins, Njomba and Sons. The next type of accounts are called nominal accounts, which are basically accounts that identify the activities or services performed by the business or performed to the business. Okay, so let's say a time comes when your business has to pay rentals for the premises you are using. Okay, that is an activity performed by the business. So such kind of activities are recorded as nominal accounts. So to understand it deeply, what you should keep in mind is all expenses are nominal accounts and all gains or incomes are nominal accounts. So all expenses such as rent, salaries, carriage, fee charges, purchases, bills including losses such as bad debt, depreciation, and drawings are nominal accounts. So terms like bad debt, depreciation, we're going to understand them later. Bad debt and depreciation. Then drawings are the money that the owner might get from the business, which might be an expense. Okay, so this is also a nominal account. Other types of accounts which are under nominal accounts are gains or income, such as sales. When you sell, you make some money. Rent received, when you receive rent, you make some money. Commission received, when you receive commission, you make some money. Also capital, when the owner injects some capital into the business, it's a gain. So gains or income and expenses are all nominal accounts. The next are real accounts. So real accounts are accounts that keep records of the assets of the businesses. Accounts of all the position of the business are nominal account. Are real accounts. Okay, your business has office furniture, it has laptops, so the premises. So all these assets are kept under real accounts. So they are sometimes called asset accounts. Examples include land and building account, motor vehicle account, etc. So now we learn how to record business transactions. Whenever there is a business transaction, there is a document that must be generated, which we call a source document. This source document is used as the first document from which information is going to be taken from. the information that is later going to be recorded in the books of accounts. Okay, so in short, processing a business begins with recording the information on a source document. Imagine this scenario where you go in a shop and you buy some things. You're going to be given a receipt. A receipt is called a source document because it's going to be used by the business to record the information pertaining to that transaction in the books of accounts. So once a receipt, which is a source document, has been generated, the next job for the accountants of that business is to identify the accounts that are involved in the transaction. What accounts are involved in the transaction? That's the next job, identify accounts. Once you identify the accounts, then the information pertaining to this transaction is supposed to be recorded in their specific accounts, in which are found in what are called subsidiary books. Okay, so in these subsidiary books we have the various accounts pertaining to this transaction, and that is where the information is going to be recorded. These subsidiary books are part of a ledger. Remember, a ledger is just a collection of accounts. So there are different types of ledgers. So depending on the type of transaction, the information is recorded in a subsidiary book, which is found in a given ledger. So we're going to end this part of this topic by discussing some types of accounts, their subsidiary books, their source documents, and the type of ledger they belong to. So we're going to start with cash sales. Remember, cash sales simply means the cash you get after selling. So the first thing to identify is what's the source document. So you are the business, you have sold something and you have received cash. You are expected to give the buyer a receipt. Okay, so a buyer is going to get a receipt. What you're going to remain with is a copy of that receipt or a duplicate receipt. That's the source document you're going to use to record information in your books of accounts. So the source document for cash from sales is a copy receipt or duplicate receipt. Okay, so once this duplicate receipt has been generated, the next job is to identify the accounts that are involved in cash sales. The first account is the cash account, since you have received some cash. The second is sales, since you have sold some goods. So sales account and cash account are going to be involved. Which account is debited? So the account to be debited and credited, in the next lesson we're going to perfect the skill of identifying which account is debited and which account is credited. But here we're going to, of course, picture the scenario. So the sales account had some goods for sale, so it has given away some goods. Then the cash account has received some cash. Therefore, the account to be debited is the cash account and the account to be credited is the sales account. So the subsidiary book which is related to such a transaction is the cash book, and the class of ledger this is part of is called the general ledger. The next transaction is credit sales, where you have sold goods on credit. So in this case, this is what happens. You as a business, you are going to issue what is called an invoice to a buyer. An invoice is going to show the types of goods that you are going to sell the buyer and their prices. Okay, so once the invoice is accepted, then you're going to give the buyer the goods and you'll be waiting for payment. Okay, so the source document is the duplicate of that invoice which you sent to the buyer. Okay, then the accounts that are involved, of course, is the buyer's account and the sales account, in which the buyer's account, in this case called the data a customer is going to receive, and the sales account is going to give. Okay, the subsidiary book is the sales journal, and the class of ledger her data's ledger, where you record people who owe you money. The third transaction is cash purchases, where you buy things on credit. Okay, so in this case, you are the one who's going to receive an invoice, and the source document is the original. this is cash purchases, not on credit. So this is where you buy things on cash. So in this case, you are going to receive the original receipt. Okay, then the accounts that are involved is the cash account and the purchases account. So your cash account will give away money since it has bought. Okay, then the purchases account is going to receive some goods. Therefore, account to be debited is the purchases and the account to be credited is the cash account. Then the subsidiary book is the cash book and the class of ledger is the general ledger. The next scenario is where you buy things on credit. So this is the one that I explained, which involves the original invoice. You receive the original invoice. So the source document is the original invoice because the person or the company you have bought goods from is going to issue you an invoice, okay, showing the goods that they have supplied to you and their prices. They will remain with the duplicate of the invoice, but you are going to receive the original invoice. Hence, the source document is the original invoice. So accounts to be debited, or the accounts that are involved are of course purchases account and the creditors account. The creditor who has given you goods is going to give away goods. Therefore, they are going to be credited, while your purchases is going to receive goods. Therefore, purchases debited and creditors account or suppliers account is going to be credited. The subsidiary book is the purchases journal and the class of ledger is creditors ledger, where you record companies or businesses that you owe money. The next is returns inwards or returns in. So this happens when you sell some goods, then the buyer is not satisfied with goods, so they bring back the goods. Okay, so what happens in here? So what happens is, first there's going to be what is called a credit note. So you have issued out goods, the buyer has paid for the goods, then the buyer maybe is not satisfied with the goods, they are giving you back the goods. So you owe money to the buyer. So you have the buyer is more like your creditor because you owe money to that buyer. Therefore, they are going to send you a credit note saying that you have our money, you have our credit. Okay, so what accounts are involved here? The first is sales returns, which records all things that you sold and have been retained. The second one, of course, is the customer. Okay, so the subsidiary book is the returns inwards journal and the class of ledger is debtors ledger. The next is returns outwards. So returns outwards is where you have bought items but you're not satisfied, so you take them back to the people you have bought items from. So the source document is the debit note, that's what it's called. So when you buy something from someone, a supplier, of course these transactions, remember, are all on credit or debit. Okay, so when you buy things, you buy them on credit. Okay, then when you send back some goods, then the supplier becomes your debtor because they have part of the money that should belong to you. Okay, hope I haven't lost you there. So you buy these things on credit. So let's say you buy they are 20 kwacha, so you're supposed to pay that person 20 kwacha. In their books, it is showing that you're supposed to pay them 20 kwacha. Then 5 kwacha of the goods are not okay, so take them back. Okay, so you are supposed to pay 20 kwacha, but they owe you a 5 kwacha also. So you send a debit note, show that they are more like your debtors. Okay, so the accounts involved here are suppliers or creditors account and purchases returns. The subsidiary book is the returns outwards and the class of ledger is the creditors ledger. The next is purchases of fixed asset on cash. Purchases of fixed asset on cash, where you buy fixed assets on cash. So this is the same as cash purchases, as the source document is going to be a receipt. The accounts to be debited is the fixed asset account. The account to be credited is the cash account. The subsidiary book is the general journal and the ledger class is the general ledger. So the next one is where where you purchase goods, but this time on credit. This is also like credit purchases. Sorry. So this one is like credit purchases. So in this one, the source document is called the invoice or journal voucher. Okay, and the account to be debited is the fixed asset account. The account to be credited is supplier's account. The subsidiary book is the purchases journal, and the ledger class is the creditor's ledger. Next, sale of fixed asset, where you sell goods on cash or check. Okay, so this analysis for cash and check are the same, meaning that the account is going to be cash account or bank account. Okay, one of the accounts that's going to be involved. So the source document is the copy of the receipt. Okay, and the account to be debited is the cash or bank, depending on the nature of the transaction, if it was cash or check. And the accounts to be credited are your asset disposal account, because you have assets, then you have decided to sell them. You can have office furniture, then you feel like, okay, these are old, so they're supposed to be sold, so it's more like you're disposing. So there is an account called asset disposal, which you're going to use. The subsidiary book is the general journal, and of course the ledger class is the general ledger. Finally, this one is important as compared maybe to these ones which involve fixed assets, as we are going to deal with it next. So this is small daily expenses. Okay, you want to buy a pen for the office use, so you get a 2kwacha, you buy a pen. So the source document is what is called a petty cash voucher. So for these ones, we record all the expenses in what is called a petty cash voucher. So the account to be debited is the expense account, okay, and the account to be credited is the petty cash. The subsidiary book is the petty cash book, and the ledger class is the general ledger. So here, if you think about it, the account to be debited being the expense account, it might be difficult for you to wrap your head around. But don't worry, in the next lesson, we're going to explain why the expense account is the account to be debited. But for now, just know that the expense account is the account to be debited, and the petty cash account is the account to be credited. Well, this was a lot of information, but what was important is to know the source documents of all these types of transactions. This other information will become clear to you as we go on. But for now, just try as much as possible to understand what you can. This marks the end of this lesson. Happy solving.